Here we go. Good morning, everybody. James here, and it is Tuesday, November 5th. And today we're going to be doing a lesson on iron condors. That is the number 2 strategy that I do probably the most here in the elite room. And I've had a lot of requests on it, so I figured we're going to do this as one of our first lessons together. So let's get started. Bring this up and over. Iron condors. What are iron condors? Iron condors, pretty much, they involve 4 contracts. Okay, you got 4 different legs, so it's gonna be 4 different strikes. Okay, you can place them all at the same time like I do, and then you can leg into them. I know I believe Dave legs into his when he does his iron condors. So you got a couple of ways that you can do it. All right, pretty much contains 2 vertical spreads. You have a call vertical spread and you have your put vertical spread, and together they create your iron condor. Okay, and an iron condor is pretty much a neutral strategy, right? You want the underlying pretty much to trade sideways within a range during the time that you have that trade on. You can skew them to be slightly bullish or slightly bearish, and we'll talk about that in a little bit as well, but for the most part they're a neutral strategy. Okay, and what I mean by 2 vertical spreads, let me see if I can make this bigger or full screen to make this a little bit easier to see for you guys. And it's down on the other screen. So let's do this. Sorry, guys. Here we go. All right. So this is what I mean by 2 vertical spreads. On the left here, you have a call vertical spread. And if you remember in chat, I talked about it. The call vertical spreads are if you want the stock to go down. So as you can see here, I believe I used Shop for this demonstration. By putting on a call spread on one side, on the call side, okay, now you have, as long as the stock goes down, you make your money. Now on the right side is the puts. So you put on a put vertical spread, and that's if you want the stock to go up. So by putting these 2 trades on at the same time, you end up getting an iron condor. And now you can see here, zoomed out, this was the calls, this was the puts. Now the range is in between here. Let's see if I can go back. No, I can't. There we go. So as the previous slide showed, the call side, right? If it goes down, you make a profit. On the put side, if it goes up, you make a profit. So by doing so, now it caps it, right? Because you can't continue making a profit. So inside this range here is going to be your profit zone. This is where you want your underlying to trade the whole time you are in that iron condor. Okay. Let's see here. And then this is the graph. Okay. This is a little bit better visual to understand your profit zone. So as you can see here, the short strikes that I showed you on the previous example, these are where you want the stock to stay in between by expiration to get your max profit. By excuse me. So over time, as long as the stock trades in between this little green zone, right in between your strikes, you're gonna make money by expiration date. Not right away, you know, not tomorrow, not today. Odds are it's gonna be negative. But by expiration, if your stock, you can see this little green flag, if this is all the way at 265 and 1 cent or 329 and 99 cents at expiration, you're going to make max profit. Now what's max profit? Max profit is the credit you received when you put this trade on. Now remember, you're selling options here. So you collect the money up front and excuse me, your max profit will be this 200, like in this case, you can see $2.35 per contract. So you're gonna make, if you held this all the way to expiration, the most you can make would be $235 per contract, as long as it stayed in between your short strikes by the expiration date. Simple enough. Okay. And then once it starts going past your short strikes, you can start to make less. You have a break-even point. You can't really see it in this example, unfortunately. Let me see if I can show you a little bit better of an example of a break-even, just so you can see it. I'll zoom in on it. Here we go. So if you look here, you can see Here's the short strike we were just talking about. Now, even if it goes against you, you can still make some money all the way up to almost, just over $2 into the money. But that's by expiration again. Okay, and you don't start seeing max loss till after your long position has been breached. At that point, you're now trading, close to max loss by expiration date. Okay. Let's see. When do you want to place these trades? Okay. Ideally, like I said, because you're selling options, you want to have a high IV environment. You want to search for underlyings that have 50, 60, 70 IVR, right? The higher, the better. But I will go as low as a 30 IV on an iron condor. And it's because you can still collect a decent credit, even with a lower IV, because you got 2 legs going in here, 4 legs, excuse me, 2 different verticals. So you collect a little bit more, even with a little bit lower of an IV. Okay. Ideally, I touched this earlier, is you want a trending sideways market. You just, not even market, the underlying needs to be trading somewhat in a range, sideways range. You don't want to put an iron condor on, well, look at Apple. Apple's flying, in the last couple of days. So you don't want to put an iron condor on Apple. That'd be a bad idea. But something that was going sideways for the last month, that would be a good trade as long as the IV is fairly high. Okay. And now you can slightly skew it bullish and bearish. Okay. But still, it's a neutral strategy. You can't get too bearish with it. Can't get too bullish with it. What I mean by that, this would be an example of slightly bearish iron condor. You go and you put your call side closer to the money, but you bring your puts further out of the money. Okay, and now as you can see, this green line, that's that profit zone I showed you earlier. Excuse me. And now, as long as the stock, here's the stock trading, but you thought it was going to go down and maybe stay down. You can kind of use this on maybe earnings ideas, right? Like you think it's going to have bad earnings, it's going to drop, but then it's going to stay down in that zone. You can skew it to be bearish. And now, as long as it stayed between this area and dropped down to this area, you'd be profitable. So that's a bearish iron condor. Okay. This would be bullish. You're doing it the other way. You bring your puts closer to the money, right? And then you bring your call side further out of the money. And now, as long as the stock stayed or went up, right, now you're going to be profitable again. Can you talk about opening iron condor? Yeah, save your questions to the end so I don't miss any, and then we'll talk about those. Okay, Scott? All right. Let's see. How do you profit? Ideally, just like any other credit spread, theta is your friend in this case. So when you're long, theta is not your friend. But when you are short, theta is your friend. So passage of time is pretty much the number, excuse me, the one way that you're going to make your money. As time goes by and those options stay out of the money, let me show you here. Let's get this skewed normal again. So as time goes by and these options stay out of the money, they're going to decay fairly fast, right? The closer you are to the money, the less amount, at the money is where theta really doesn't come out until expiration date. But the further away you are, these option prices start to decrease fairly fast. And I can come up here and I can show you they're much cheaper down here. Okay, look at the 335s. If we brought that down, they're trading pretty much where you'd, 5 cents, 10 cents. But at the money is trading still pretty similar, 4 or 5. Okay, so theta won't come out as much. But as they stay out of the money, you're going to profit over time. The values are going to come down. Again, IV contraction as well. So like I said, you want high IV. Say you get in one with maybe a 50 IV. Over time, you want the IV to come out because the more IV that's in it, the more value is in those option prices. Even if you are out of the money and you bought it or you sold it at a high IV, you still need that contraction as well to help with the decrease in in your prices of the stock, or in the contract, excuse me. All right, and then of course, obviously, is by expiration, if the stock stays in between your short strikes, you make max profit. Okay, so sometimes you'll see, like especially with earning plays, you might be in a spread and it's not making profit, even though you're getting closer and closer to expiration. And that's because IV tends to maybe go up a little bit as earnings comes in. So you may have bought it at a 50 IV and it's now at 55. Your option prices are actually kind of worth more at this time. So that's what you got to kind of watch out for with earnings plays. Also, quick drops in the market will raise your IV. So that doesn't help either. So you want a neutral over time passage, right? And that's going to make your money on an iron condor. They do take a little bit longer to profit because you don't want a direct move up or down. You know, on a vertical spread, if we got in at the right time and the stock goes up and you had a put spread, you're going to profit fairly quickly because those option prices are getting further and further out of the money, and you're good. But on an iron condor, because you're hedged on both sides, you really don't want a big move up or down because, as you know, the prices are worth more at the money and you're not really going to have any profit in there. So as long as it stays going sideways, it'll profit. Okay. Let's see next. Oh, wrong side. When you manage. Okay, when I manage may be different than when you guys manage. I manage all my spreads typically at 50% of max profit. Okay. That's mainly because of risk and reward. You get in, and I actually didn't touch about this on entering. I typically get in, I'll backtrack really quick. I try to get in my spreads. Let's see, do I have when to place a trade? I didn't put it on here. I like to go 30 to 45 days out when I enter any spread. Okay, that gives time for the trade to work, trade for it to work if it went against you right away, something like that. So assuming you get in, 30, 45 days out, when you manage, I manage at 50%. Iron condors take a little bit longer than a short strangle or even a vertical spread, and that's just because you really need it to move. And when the stock goes up or down, you're closer to the money one side or the other, and really theta is what's going to make your money. Okay, so 50% works, especially say you got a 45-day trade on, you hit 50% in 20 days. That's a long time. That's typically more than I'm in a vertical spread. But if you want to get that 100%, but you already hit 50 and you still have 25 days to go, you can see that trade go completely against you, and now you have a loss at expiration because it's hard to roll. It's hard to defense an iron condor. So if you don't manage correctly, you can see a nice winner turn into a max loser really quick, especially in nowadays market, right? One tweet and your trade is blowing up. So effectively manage your trade. I say 50%. Now my plan is actually 30% up to 5 days. I don't see that a lot on iron condors as I do on vertical spreads. But if my trade is hitting 30% or more from 5 days of me putting that trade on, I'm taking it off. 30% is huge. Anybody will agree with me. You're in 30% in under 5 days. That's a heck of a run. It doesn't matter one contract or 50 contracts, right? So if you hit 50 and you still have 20 days to go, it's the same situation. Effectively manage your trade, and you'll be more profitable than you will be losers. Okay. Now you can play a little bit of defense. If the stock rallied up, we had examples with Ulta at one point in time, and it rallied up and it's not moving, you can roll up certain sides of your trade to collect additional premium. And this will pretty much raise your max profit because you're adding credits to sorry, I'm just looking really quick. You're adding premium to the already premium you collected, so now you have a much larger max profit, and you're lowering your max loss. Okay, so you can roll up or down your calls and puts to collect more credit. You can roll to another expiration. Rolling is really hard to do. You'll see me roll on the same expiration, just rolling down the calls or rolling up the puts. But rolling out to another expiration is really hard to do, because once you're in the money, you really can't roll for a credit, and you got to hope that the other half of your trade covers that debit that you're gonna pay. If you're out of the money, you can get a credit, but that's where the kind of the predicament comes up. Well, you're already out of the money again. Now I don't need to roll. So you gotta use your best judgment on that. And you know, am I 2 days away? I'm finally out of the money, and is there a chance I'm going to be tested again, or do I roll it, close it? There's a lot to do. So I don't like to roll iron condors to a further date if I don't have to, but I will roll them up if something's going against me and it's not going to come down and I'm way out of the money on one side. Okay. Wrong side again. Oh my goodness, I didn't have you guys on the wrong screen. I apologize. That's okay. And that's the end of my slide. Okay. So that's really it on an iron condor. Okay, that's how you would put the trade on, what you want to look for, when to manage it. Let's start with questions. What do you guys got any questions on this? Let me touch base on those now. All right, let's see. 30 days, Scott. Exactly. Good point there. Jeff, give me 1 second. Wesley, rolling up to collect additional premium iron condors. You were talking about opening additional. No. Okay, that's a good point, Wesley. Let me show you here. So we go over to shop, okay? And let me get this out of the way. Say that you are now, you had a regular centered iron condor on, and say shop is now testing your calls, right? Now shop's way up here, and you have these puts way out of the money, okay? What you can do is, I'm gonna have to clear this out, but so 242.35. So say now, instead of you being centered, you're way down out of the money on your puts. And it doesn't look like the shop's gonna come down that far. You can start protecting yourself a little bit. So what you would do is you would close these two trades, right? So you saw me do the opposite. Here's the original, you're short and then long. What you would do, buy to close, sell to close, and then you just roll them up. And you can see what I mean by up is they're at 240 and you're gonna roll up to a higher strike. So say 260, 255. Now you see here, now it's a 60-cent credit from where it's trading at right now. So say you got $2 on the original iron condor, and now you know your side's being tested on the call side. You're gonna roll these puts up and collect in another 50 cents. So now you have a total net credit of $2.50. Okay, on a $5 wide. Now you're 1-to-1, risk one to make one, versus you were slightly, risking more. And then now if shop comes down, you still have some wiggle room, right? You don't want to roll like all the way up here like this and collect a huge credit, because then if you had, you were over here with this original trade and you rolled it this close, you have no wiggle room, especially with shop that can move, $37 roughly by December. So I usually start small and slowly roll up over multiple times if it looks like it's staying in this area. Okay, and then I'll end up rolling all the way up to an iron fly. That'll be the last roll I would ever do. I try not to do that too much because iron flies, again, don't profit the most until expiration. And if you rolled it into an iron fly with 20 days to go, you're really hoping for a move, okay? Or a lack thereof of a move, because now you need it to stay in that zone, okay? My preferred delta. I start, when I put an iron condor on, at roughly the 20 delta, okay? And I see what kind of credit I'm gonna get at that point. Just like any other spread, I personally like to get 1/3 the width of the strike. So on a $5 wide, I wanna try to get as close as possible to $1.65. This trade alone, you can see at a 20 delta, gives me $1.85. So that's already 20 cents above what I look for. Now I kind of look at it and you can kind of see that they think shop's going to come down, more so here. So I would end up starting to do something like this. All right, well, I went now further than the expected move, I still get a decent credit. Well, I'm going to go a little bit further, right? Iron Condors, you got a lot more wiggle room. So it's all about comfortableness, where you like it. And you see here, I'm pretty much at a 1 standard deviation now, and I'm collecting 1/3 the width. You see that my probabilities are still really good on this trade. So this is what I kind of look for. I start at the 20 and I work my way up or down. You know, if it has a small expected move, I might go up to a 30 delta area, collect a really good credit. Or, you know, if it's got a large expected move, I'll start moving it on. Standard deviation is the 16 delta scale. Let's see. So like I said, I always start at the 20 delta on Iron Condors and then work my way around. All right. And then if I don't get a reasonable credit at a reasonable distance away, I won't take the trade. So I look for on probabilities, because I am a probabilities trader. I try to get it like a 60% on my pop. So as you can see here, if I went back to a 20 delta, it's about a 57. So I like a little bit more than that. You know, roughly it's 50-50 is what some people do. I go a little bit higher. So this is something I would start looking at on an Iron Condor. 60, 70. Credit is really good. Boom, you take the trade, let it go. Okay. How do I pick my expiration dates? I go 30 to 45 days, right? That's a tasty trade thing. I tried it. It worked for me, so I do that. 30 to 45 days, like I said earlier, it gives you time if the trade goes against you. Iron Condors, I think you have a 66% chance that one side of your Iron Condor will be tested during that trade. Meaning that you put this on, there's roughly a 66% chance that it will touch one of your short strikes before you're out of that trade. Okay. But there's a 70% chance that you're going to make 50% overall. I take those odds. Okay. But I usually go, 30, 45 days, right? Back on that question. I try to make sure it's a monthly. Monthlies have a lot more liquidity unless you're trading SPY, right? Then you can trade any expiration at that point. But the monthlies always have, typically, I won't say always, have more liquidity. They're easier to get in and out of. But sometimes you'll see it line up that the next monthly is 60-something days or 50-something days, and all you have is weeklies to choose from. So then you got to make that choice. Do I go all the way out 60 days, or do I try to get filled on a weekly? But I usually try to go no less than 30 days and really no more than 50, because that's a long time. All right. Can I talk about opening an Iron Condor after a crash like you did on Ulta? Let me see. Let me pull that chart up really quick just so I can refresh my memory on that. Ulta here. Okay, this crash right here. If I remember right, we're talking about this crash right here. After earnings, it dropped, and then we got into an Iron Condor about over here. What I did on that one is when you see big drops like that, sometimes they tend to go sideways after a while. And Ulta, it kind of did that already. If you look at this daily chart here, it was trending pretty much sideways for 4 or 5 months. It crashed with earnings, but look at it again, it's back to sideways. So I ended up taking that trade and I put it on. The IV was still fairly okay. Earnings came out, your IV goes away. But the IV was still, if I remember right, was still fairly decent on that trade. So that's why I put the Iron Condor on. And I actually put on another one because we're in one right now. Okay. Let's see. If you are worried about maintenance requirements, would you open the other trade before closing the first trade? Leslie, I'm not quite sure I understand that question. Is it generally an earnings play? And can you explain the profit analysis screen? No, it's not typically a earnings play. I'll put them on outside of earnings. I got Ulta, we have UVXY. So it's not necessarily an earnings play. I use them for earnings because the high IV, the immediate contraction after earnings, you can typically profit fairly quickly overnight on an iron condor on that. Okay. Yeah, it's Scott, let me show you. So it's typically a 16 delta is your one standard deviation. And Tasty Trade's fairly good at showing you that. What does rolling consist of, and what happens each time you move around? So rolling, Mark, is you're just closing the current trade you're in and either rolling it up or down on the same expiration or out to a new expiration, right? And typically rolling is, I still think this trade is going to work, right? My plan is still in effect. I still think it's going to work. I just need a little bit more time. Rolling is really hard on defined risk trades. And since an iron condor is defined risk, it is really, really hard to do. That's why I rarely do it out in time. Short strangles, naked positions, those are a lot easier to roll. Okay. But typically what happens is you're going to close it and then you reopen the trade, and you want to get a credit when you roll. I don't want to say ever, you don't want to roll for a debit. I will roll for a debit overall if it's under 10 cents and I received at least $1.65 on the trade. Because after that, if you rolled for a debit, you're already subtracting off your initial credit, and now you need it to actually drop further to make your 50% on the trade. So if you roll for a credit, you're adding onto it, and now actually instead of you needing 50-cent debit, you might only need 75-cent debit because of the extra credit you got. Okay, so rolling can go for you or against you. If you roll too soon, it can come back and bite you in the butt, and now you're negative because you may have rolled up and tight, and now it dropped back down, right? I've done that a handful of times. I think Ulta actually did it. If I would have left Ulta alone, it would have been a profitable sooner. I still profited on the trade, but I went through like 2 different rolls. Whereas if I left it alone because I rolled it a little early, it would have been profitable. Okay, so your timing is right. Typically, I roll between 10 and 20 days left on the trade. Okay, and I don't. You do not roll the tested side away, Wayne. You leave the tested side alone and you roll the untested side. So like if this was being tested and you're like this, then you roll these ones up to collect a credit. You start trying to roll these down and you're going to get debits, and then you're going to have to roll this side up to get a credit to pay for the down. So you typically leave the tested side alone and roll the way out of the money untested side up. And I do it over time, right? I don't go from deep out of the money to a 30 delta, okay? Because if it came back down, because remember, you get tested 66% of the time. If it comes back down and you rolled too far up, now you're in the money on the other side. So I roll, and other people are different, but I will roll smaller, okay? I will roll for smaller credits and then give it a couple of days and see if the underlying moves back down or back up. And then if it still puts me back out of the money some more, I roll again, collect a little bit more. You know what I mean? Another 25 cents, right? And then I do it again and again until you get to a right amount of credit or closeness, or you're on an iron fly now, or whatever the case may be. Okay. All right, let's see. Just curious, why do you use iron condors on earnings? Iron condors stock is neutral, but during earnings, most stock is a big move. Question is, okay, so Dennis, I actually, on earnings, I prefer to do short strangles, a naked position, because you have a much better chance of being profitable because you don't have that hedge from the long side. But on an iron condor, it just makes it more affordable. And I'll show you. Shop right here is a good example. And my earnings times, I completely go outside of my plan, right? I don't go, you know, a 20 delta. If you guys noticed, I've been going pretty far out of the money and collecting a lot less than 1/3 the width of the strikes, because even if it goes against you, right, the contraction in IV, let me see which one had a good one. What was really high that we just had earnings on? It's probably not going to be high anymore, but Uber. Okay, you can see here the IV on the weeklies are really high, and then you can see the back months are down at 50. What typically happens is the one that's closest to earnings is high, and after earnings comes, you see like a 10 to 20% drop in IV, and then over time it continues to drop down to its neutral time. So you're using this these iron condors as a synthetic strangle, and you just capitalize on the decrease in IV. Okay. But it's being a lot more affordable. You go do here, I show you here, you just do a 1 standard deviation strangle. Buying power is huge. Hold on. So you can see that the buying power is $3,700. Not a lot of people have that to throw out on a strangle, but if you turn it into an iron condor, it makes it much more affordable. Sure, you don't make as much, but if you're correct and it stays at least within the expected range, then you'll profit on the trade. So that's why I use iron condors when I can't do Uber. I did a short strangle on because it's a much more affordable stock. But Shop, Amazon, those sorts of things, it's easier to do an iron condor, and the wider you go, the better. Okay, but that earnings plays are a whole different subject. Yes, Ariel, this is being recorded. If you close one side of the iron condor, doesn't mess with your... Yeah. Okay, Wes, I see what you're saying. So, an iron condor, you technically get a free trade. All right? You only have to put maintenance up on one side of the play. You see here, 392, right? That's my buying power requirement for a vertical. And if I go and do another one, the buying power actually reduced a little bit here. Okay, it doesn't double it. But when you leg out, if you were to go close this, and I have one I can show you, because here, let me see. I have a vertical somewhere, right? Do we have a winning vertical that I can use? I don't think I do. We're in a lot of iron condors right now. SPX, I'm just going to go to that one. So just to show you what I mean by the maintenance requirement. So SPX costs such and such, probably $350 something. You go and turn this into an iron condor, see if it works. It's going to show, no, it's going to show me wrong. It's because it's deep in the money. That's a bad example. I don't have one I can show you on. Typically, if you do it right, it's because these are all deep in the money. I can't even show you. If you had a vertical spread on and it was out of the money, when you go put another vertical on, it won't show you any additional maintenance requirements. It'll actually just show you additional credit. And then if you go to leg out of it, which I can show you, UVXY is an iron condor. If we close the side being tested, it's gonna reduce my buying power by an additional 195, and that's because I'm closing one side of this trade, but I'm still required to keep the full maximum maintenance on. So sometimes you can't, if you're playing tight in a small account, you might not be able to leg out of it because you might only have $100 left in your account and you have the free kind of trade on and you can't close it, and that kind of stops you from rolling and stuff like that. So it's always good to make sure you have enough money in your account to cover these. If you wanted to leg out, like you're deep in the money and you want to get out of this one and just let the call side go, you need to make sure you have enough funds in your account to cover the maintenance requirement that is required if you take one side off. So I hope I answered that right for you. What happened to your pinch of strangle? I still have the pinch of strangle on. It's right here. It's actually positive right now, even though I am in the money. And I can just kind of touch base on this and just show you. Okay, the strangles are a little bit different. You guys can see that even though I'm past my strikes, I'm actually profitable right now. And as long as it stays above $20, I'll be profitable in this trade. Whereas if this was an iron condor, this would almost come straight flat down, and I might not be profitable. But that's a whole. The strangles are a whole nother thing. Exactly, Steven. You can get good credits. Let's see. Yeah, Dennis, I don't do straddles too much. Again, another topic. Straddles, you need to be, you got to be right. There's not a lot of wiggle room. You see this straddle here covers the expected move, covers a couple of bucks down. Credit is obviously way nicer, but if you just go a little bit out of the money, it's a much larger break-even spot, a little bit more room. So it's always safer. It's always safer to go further out of the money, right? Strangles are, or shadows are really tight. You need it to stay at that range. Okay. Harley, I understand you start with a 20 delta and want 1/3 the width. What are factors do you consider in determining the strikes so it stays within the expected range, like ATR, earnings, etc.? So I really don't. I am more of just a probability trader, Harley. So when I'm looking to put trades on, Pinterest isn't a good one. We'll go back up to shop just because it's $5 wide. When I'm looking to put trades on, I look at IV, right? This doesn't have a lot here, but the monthly has almost twice as much. So you can sometimes get a little bit better premium. Okay, premium is good. It's almost 1/3 the width. And then I look at probabilities. These are really it. This is my first determination. What's the IV? What's the credit look like at the 30 delta? And what's the probability? I don't care about ATR on spreads. Earnings, I want at least 3 weeks out. Okay, because you can't let earnings dictate your trading, or you're just never going to have enough to trade because of all the earnings that happen. So I try to stay at least 3 weeks out because my average hold time is 8 to 10 days. So if I go 21 days out, there's an odds are I'll be out of the trade, but not always, as we found out with Starbucks and a couple of other positions. But so that's really it. Other than that, I don't care about, you know, I wanna stay within a trend. So you'll see me come in and look like, okay, shop's bullish. If I go over here and I find a strike below this and the probabilities are good, I'll take the trade. But I won't be like, you know, I'm gonna put a call spread in right here and hope it's gonna keep going down, because that's really not your trend's your friend. Right now the trend is still technically bullish and we're just consolidating right here, you know. So that's all I really look for. Yes, Mark, theta is your ally in any spread credit trade that you do, whether you just sell naked puts, naked calls, or an iron condor, a credit vertical spread, a short strangle. Theta is your friend, right? I want time to go by. I want that theta to come in. So you can see here, theta, this is not a big theta, but this theta is a positive 83 cents. So as of right now, at this very time and moment, I can make 83 cents a day, right? It's going to change. It's all dynamic, whatever. It's going to change, but you want that to be positive. Whereas if I just went long, I'm negative 21. So selling options is always your friend. You're better than the house, right? Positive theta, $1 here. So theta is your friend. You want to have positive theta. Over time, that means I'm going to make money every day. Okay. Let's see. What is the probability range you're looking for in iron condor? Okay. I look for 60% on the pop. Okay. That may be high to some people. And I may be giving away a lot of credit because on my verticals, I like to see 65 on the pop. So when I go in Iron Condor, I like to see at least 60. And that's just me. That's my comfortableness. That shows that I have a good chance. A lot of people will come up and do 30 deltas on their Iron Condors and sit about a 50. Okay. The credit, I mean, look at the credit. This is risking one to make one pretty much at a 30. But you just go a little bit further out of the money and the probabilities go up significantly. Right now I'm at 50, 60. So you just keep jumping it out a little bit. Credit's still good. Probability's now even higher. So I like to see about 60 if at all possible. That gives me a really good chance on these trades. Okay. The IV range again, Harley. I like to do 50 and above, right? Anything at 50 or higher is considered high. Iron Condors, I'll go down to 30. And I'm not against this because this is 23.5, but the December monthly is actually IV sitting at 48. So I would take this trade. I mean, you look at it, we've already looked at one standard deviation. It was pretty much a really good credit still. So the guide for me is a 30, no less than 30, but I will kind of bend the rule if the credit is still fairly decent, right? So can I write them down, Michael? Like my rule? Yeah, you know, I think I could. When I upload the video, I can kind of put a quick summary in the comment section if that helps. Maybe that'll help. Just kind of entry exit type rules. I can do something like that, and I can upload that tonight with this lesson. Average credit, Julie. I try to get 1/3 the width, right? So I will take, I mean, any trade for me, $1.50 to $1.60 is like, I'll take the trade. I'm happy with a $1.50. Okay. When I start getting down to $1.30, $1.25, I'm putting a lot more risk out there. I don't like it. So I try to get $1.50 or more. Occasionally though, when there's just no IV in anything, you really don't have a choice. I don't like doing debit spreads. People say, do a debit spread when IV is low, blah, blah, blah. I don't like doing that. I will sell smaller. I'll take a little bit less, raise my probability a lot more or something, and go a little bit less.
According to Wikipedia, Less is a satirical comedy novel.
That's funny. Google just, my phone just, did I say Google? All right. Yeah, $1.50. Well, it's not $5 risk either, Scott. You got to think, at least with Tasty Trade, it's not a $5 risk. You look at this here, my risk is $355, right? Or $350 for getting $1.50 in credit. So, whereas other brokers are going to make you put the full 500 up, that's not really your risk. Your risk is just the max loss, which is the difference of $5. So, it's really 150 risking 350. It's 2 to 1, almost a little over 2 to 1. That's not bad. A lot of people risk more than that. So net credit, net debit, little confusing. It is because you're used to buying low and selling high. But all credit spreads are always a credit, and that's just because you're receiving money up front, and that's because you're selling closer to the money, right? So when you have everything that gets close to the money is obviously going to be worth more than the one behind it. So when you sell close to the money, this option is worth more than this one. So then you get that net credit. Okay, David? So that's why you're always getting the credit up front and you're buying it back when you go to close the position. So it's just like shorting a stock. You shorted it, now you're going to cover it. So once you get the hang of it, you'll understand. Hey, SPY's coming back down. Okay, can I talk percents? I shoot for like what I go for. I shoot for 50% of max profit. So my max profit would be $1.50. I would want to buy this trade back for 75 cents. That would give me a 50% max profit. Now ROI, that's a whole nother thing. I don't calculate the ROI. The risk on investment. I don't do that. I just calculate the percent of max profit. I'm sure if I could create a spreadsheet. Well, I have the spreadsheet. You guys see, I can add the ROI column and give you that, but I don't calculate it based on the ROI. I just take the 50% of max profit. Okay. All right. So let's see. You guys want to find an iron condor to trade? We can put one on. We can see if we can scan through and find something that is trading semi-neutral. We can put one on if you guys are interested in that. Yeah, sure. All right. Costco's doing nice. All right. Okay, so let's I'm just going to go what I do. The scanner that I have does have an IVR on here, but I've noticed a lot lately there's not a lot with high IV. So we're going to look and see what this shows, and then we will see what we find off of this. Otherwise, we may just start naming off symbols and looking for them. That was not a straight line on SPY. So we'll start and just kind of see what we have and looking. We're looking just for something basically sideways-ish, right? And a decent IVC. This, I mean, EMD, this, you can see this is sideways action right here. It's technically considered bullish, right? You got the bullish run, pull it off its highs, and it's consolidating. So this little area here is what I'm looking for. Oops, that's a zoom button. I'm looking for like this stuff, right? That's a sideways action. This will get me to come back up EMB just to look at it. Okay. So when I pull it up, you can see the IV is 47. That's good. Decent volume. That's good. Okay. And we look not good here. Like these are 9s, but we'll just check. And that range was roughly 112 to 114. Yeah. See, so 30 delta. These are dollars. I don't like dollar wides. So if we go $3 wide, that gives 58 cents, 30, 60, 90, not enough credit. So this one did not work. So we just keep looking, right? Not waste management. I think I have a video on it already, Scott. I can double check. So these are all just kind of a lot of bullish stocks right now. Let's see. SPG, Terry. It's a little, I mean, yeah, I could see it here a little bit. I've been watched it before. We have this little range here that we can kind of look at. It's on its lows, so we can check that out. Already had earnings, right? Yep. So let's see, SPG. 19 IV, not a lot of IV on that one. That one won't work. Actually, it might work. Let's see. What is this range? 165, 140. Ugh. And it's centered right here. So centered at 157. Okay. Credit's a little low. We'll keep looking here. Burlington, maybe? Yeah, that's a good one, right? We got right off its highs. So there's a good little range. So it's been sideways since August, pretty much. So we want to look around, because this is what I kind of look at too. Remember I said I go to the 30 delta, but I want to look and see the range it's in. So the highs 210, right? And then 188. So we'll come back up here. We'll go to Burlington. Burlington's sitting at 30. November 27th. So we have 22 days. It's going to be close, right? 210's its high. So we'll jump down here for now. And the low was about 190. So we go to the 190s. Okay. That's a lot of credit. Oh, hold on. It's $10 wide. 30, 60. So, okay. This is not too bad here, right? 50, it's a little low. That I don't really like this, but this here, 70%, that's really good. That means there's a 70% chance that we can get half of this credit. Okay, it is $10 wide on the call side, so that's going to be a problem. But you can see the expected move. They actually think that Burlington's going to fall a little bit more. So I don't like it. I try not to do $10 wides unless they're earning place. Stars, I think that one's a small end stock. Yeah, okay, 14, not a lot. Let's just check that. Okay, the credit's there. Let's check the chart. Okay, so the chart on this one, zoom out. Okay, it's not really zooming out. All right, so yeah, we zoom, we kind of bring it down. Now you can see the sideways range. Definitely has it, so that's not bad. We got no earnings in the way till after the end of the year, so that's good. What I don't like on the stars one here is it's got a 14. So this one would be one that we're going to hold longer because there's not a lot of IV to come out of it. So you almost have to hold all the way to expiration. So you can see here, I already pre-marked it. 175 is roughly the area and 215. So this concerns me because that's the range here right now that it kind of moves in. So I would go back up. Tasty Trade expects only an 8.5 roughly dollar move. So looking at that, we're sitting about a 20 delta with $1.60, really good. Close to 60%. Dennis has a lot. And 70%. So this is good. I like these probabilities. And looking at the chart, it's pretty much sideways. Okay, I wanted to check the liquidity. This is a problem, 218,000. So not a lot of liquidity in it. We might have a hard time getting filled if we took this trade. So let's see what else there is that we can place. We'll go back over here. Dennis has a lot for us. ANF, Abercrombie and Finch. Let's see. Is the chart not loading? Not loading on anything. Uh-oh. LB. There's ANF. So ANF, okay. We have a little bit of sideways action here at the lows. What? So yeah, I was actually looking at a strangle before. So this is a smaller stock. This might be a strangle possibility, which is the same thing as an iron condor. The lower end stocks are hard to put iron condors on. And I'll show you why ANF will work. Okay, so it does have earnings. 21 days out. But just to show you these lower price stocks, it's going to be a lot easier to do a strangle. Okay, because after that, you really don't want to do an iron condor like $1 or $2 wide. It doesn't really make any profit. You got to wait till expiration. So $3 wide typically is what you want to do. $2.50 would be the absolute lowest if they had a 50-cent strike. So looking at this, you know, 30, 60, 90. This is just shy of 1/3 the width. Not bad. We can actually probably put this on, right? Because the probabilities are good. 62%, so it's above what I like to see. And then 77 for half that price. $3 wide. It's 9 o'clock. A little low on volume, but it's almost got 1 million. So I can live with it. 3 stars by Tasty. This isn't bad, okay? The expected move is covered. I like to see that. And then we know it's pretty much trending sideways here. You got a low of around 13.5, high right around 19.5. So we take this 19.5. We're covered a little bit more to the high side here. Not bad. I like the trade. Probabilities are good. Okay. Let's see if there's anything just a little better. What I don't like is it's got earnings in 3 weeks. So let's just check. We're going to watch ANF. That's a lot better than stars. So I like that. Okay. LB, that one's got earnings too soon, I can already tell. ADI, okay, that's a little bit sideways, a little bit higher in stock, not bad. So let's check out ADI. ADI, Okay, it's got earnings soon too. I'd hate to put on this trade with earnings coming up. And just looking at the 20 delta, credit is nice. Same probabilities. Okay, let's see. ADI 105, 120. 105 is right at support. And 120 is fairly high. So ETFs will work, absolutely. You can put them on ETFs, you can put them on indexes. It doesn't have to be just an equity. So ADI looks pretty good. Okay, we do have earnings coming up in 20 days. Not a big mover, $7, that's good. Okay, and actually doesn't expect to move much for earnings, so we can do ADI. Let's just really quick check some of these other ones that Dennis gave us, and we'll find that trade. We're getting past 9 o'clock, but this video is going to be really long. Let's see. IDKS. It's DKS. Dick's Sporting Goods. Okay, I don't like that one. Just looking at the daily chart. MRO. I don't like that one. Target. No, I don't like that one either. Walmart. No, Walmart's too much on its highs. Okay, J&J maybe, but J&J's got a lot of lawsuits going on, but that's okay. So let's check out J&J. J&J, little low on the IV. A little too much out of comfort zone. Probably not going to be anything in here. Yeah. Okay, J&J's out. Ray says snap. Little low again, but these are higher. What's the chart look like? It would be more of a strangle. It's too low, I can already tell you. ATVI. Yeah, Activision. Activision's got it, and you know what else has it? Is EA. Let's look at EA. Okay. I've been doing a lot on EA. Oh, it's only got one IV. Not doing that. Activision. ATVI. 27. A little bit better here. Gotta wait on Activision. It's got earnings tomorrow. So Activision's won't work. McDonald's won't work either. McDonald's is kind of running up. Yeah. All right. So I think we're going to go back to that one. ADI. That one had a good credit. Good probabilities. 21 days out on earnings, so it gives us time. Okay. 20 deltas. So we're good there. We're right inside the expected range. This is good. I like this. So we're going to go ahead and put this trade on. So you can see right around 160. So let's go for it here. And instant fill, 167. All right. So let's get this in. And we're going to go in ADI Iron Condor. And we did 1220 expiration. 1220 expiration, and we sold to open the 105, bought to open the 100 puts, and we sold to open the 120 and bought to open the 125 calls, and we got a credit of $1.67. Okay, and we want looking for 50% of max. All right, so that's the trade. I'm gonna go ahead and stop this recording, guys.